Hello everyone. Today our topic would be how to calculate material cost and stock levels. Material cost are calculated in three ways. As first one is FIFO, first in first out. Second one is LIFO, last in first out. And third one is weighted average method. Throughout this we find the total expenses spent for raw material used in production. Our other topic is stock levels focus on different stock levels that are essential to maintain sufficient stock in the factory. This is how we allocate the topics to each of our members. The material cost calculation part is explained by Kavishka, Layan V and Kaushi, and stock level part is explained by Nayana and Nilakshi. Okay, let's now look at stock valuation method within an example. We talk about this within an example. I think it would be easier for us if we applied the same question to all three stock methods. Let's see the question. From the following information, prepare a stock card for material zinc for the month of July 2023. 1st of July, opening stock 150 units, 15 rupees per unit. 5th of July, received 200 units under GRN number 501, 18 rupees per unit. 10th of July, issued 100 units under issue note number 701. 15th of July, received 100 units under GRN number 502, 90 rupees per unit. 20th of July, issued 150 units under issue note 702. 25th of July, received 80 units under GRN number 503, 70 rupees per unit. 30th of July, issued 50 units under issue note number 703.
FIFO method. Under the FIFO method, the oldest inventory is sold or used first, meaning the items you buy first are the first one to leave your stock. This helps maintain accurate inventory when prices change. FIFO gives accurate inventory valuation, is simple to use, match physical inventory flow and shows higher profit during inflation. It is best for items like food or medicine where order stock must be should first. Okay, now let's look at how to calculate using the FIFO method. On July 1st, 150 units are purchased and 15 rupees each. Total value is 2250 rupees. This is the opening stock. Next, on July 5th, 200 units are purchased at 18 rupees each. So now the balance is 150 units at 15 rupees, 200 units at 18 rupees. On July 10th, 100 units are sold according to 5 for the orders stock, which is 150 units at 15 rupees is used first. So 100 units are issued from that remaining. 50 units at 15 rupees, 200 units at 18 rupees. On July 5th, 120 units are purchased at 19 rupees each. So now the balance is 50 units at 15 rupees, 200 units at 18 rupees, 120 units at 19 rupees. On July 20th, 150 units are sold. First, 50 units from 15 rupees stock are sold. Then 100 unit from 18 stock. Balance became 100 unit at 18 rupees, 120 unit at 19 rupees. On July 25th, 80 units are purchased at 17 rupees. So now the balance is 100 units at 18 rupees, 120 units at 19 rupees, 80 units at 17 rupees. On July 3rd, 50 units and sold. FIFO means the orders 100 units and 18 rupees is used first. So 50 are issued from that balance. 50 units at 18 rupees, 120 units 19 rupees, 80 units at 17 rupees.
LIFO is another method to calculate the purchases and issues of stocks in a factory. LIFO stands for last in first out, which means the lastly purchased stock will be issued first. Why do we use LIFO? For several reasons, such as tax benefits, matching recent costs with current revenue, and to value inventory. Further uses are shown in this slide. Let's discuss how to calculate LIFO using an example. So in July 1st, opening stock is 150 units at the 15 rupees price. This we need to enter in the balance column as it's the opening balance. On July 5th, it says it received 200 units at 18 rupees per unit. This is a purchase, therefore we record the relevant quantity and price in the purchase column, and by multiplying price and quantity we calculate the value, which is 3600 rupees. The balance column is a updating column, thus we again record the opening balance and write below it the July 5th purchase. On July 10th, 100 units of goods were issued. In LIFO method, we issue the finally purchased stock first. Thus, 100 units from the July 5th stock is issued. In the balance, the last entry as at 5th July shows 200 units at the price of 18. From this 200, we issue 100 units at the price of 18 rupees. This issue is recorded in the issue column, also referred as the sales column in the slide. Once the 100 units are issued, the balance gets reduced. Thus, we update the balance column by removing 100 units from 200 units at 18 price entry. The same steps are repeated till the end. The key feature of this method is that we always issue the finally purchased stock first. By calculating this way, we get the final stock balance as 510 rupees.
VAM, weight average method. What is VAM? VAM is the method used to find the average price of the same product bought at different prices. VAM is a way to calculate the average cost of stock. It helps in calculating profit and managing stock better. It makes it easier to know the value of stock accurately. Weight average method, VAM. Why do we use VAM? First one, simplifies inventory costing. Sometimes we buy the same item at different prices. Second one, stable cost fluctuations. Give a fair and stable cost per unit. Third one, useful in bulk or continuous production. Provide consistent pricing for production costing. Fourth one, accepted by accounting standard. Widely accepted for financial reporting and tax purposes. Weight average method. Using this as an example, imagine 1st of July you brought 150 unit at 15 rupees each. How we can calculate these purchase value? This is the method. unit multiplied by price, you can get this purchase value. Like this, 150 units multiplied by 15 rupees. This purchase value is 2250. Then the next day, 5th of July, you brought 200 units at 18 rupees each. How we can calculate this purchase value? It is same for previous purchase value calculation. 200 units multiplied by 18 rupees. This purchase value is 3600. So, total unit can be calculated as 150 units plus 200 units. Total units are 350. Then the total value can be calculated as 2250 plus 3600. The total value is 5850 rupees. Then the average price can be calculated as 5850 divided by 350. The average price is 16.71 rupees. Then 10th of July, you sell 100 units. How we can calculate this 100 units price? This price is total unit price. It is 16.71. This sale value, it is same for previous value calculation. 100 units multiplied by 16.71 rupees. The value is 1671. Then the balance. 350 units deduct 100 units. The balance units are 250. The price is same, 16.71. The value calculation, like previous value calculation, 250 units multiplied by 16.71. The total value is 4177.5. This price shows the average cost of each unit in stock.
Okay, now we talk about stock level concepts. Let's see an example. Minimum consumption 100 kilograms per day. Maximum consumption 150 kilograms per day. Reorder period 10-14 days. Emergency supply times 3 days. Annual consumption 12,000 kilograms. Unit cost 10 rupees per kilograms. Storage cost 12 rupees. Ordering cost 200 rupees. From the following information, calculate first one, economic order quantity and total annual carrying and ordering cost at the quantity. Second one, reorder level. Third one, minimum level. Fourth one, maximum stock. And fifth one, danger level.
Economic order quantity EOQ. It is the order which gives maximum economy in purchasing any materials and ultimately contribution toward maintaining the materials at the optimal level and minimum cost. The quantity to order at a given time must be determined by balancing two facts. One, the cost of processing or carrying materials. Two, the cost of acquiring or ordering materials. Formula here is shown below. A mean demand for year, CP mean cost to place a single order, CH mean cost of one unit inventory for year. Reordering level. This is the level of materials at which a new order of supply of materials is to be placed. In other words, at this level a purchase requisition is made out. Order point are the based on usage during time necessary to requisitions and order and receive materials plus an allowance for protections against stock out. Formula of reordering level. Reorder level equal maximum usage multiplications lead time.
Minimum level. The minimum level is the lowest quantity of material that must always be kept in store. This is calculated in minimum level equals to reorder level minus average consumption into average reorder period. Reorder level 2100, average consumption 125, average reorder period 12. Then the answer here is 600 units. Maximum level. The maximum level is the highest quantity of material that should kept in a store. This is calculated in maximum level equals to reorder level plus EOQ minus minimum consumption into minimum reorder period. Reorder level 2100, EOQ 2000, minimum consumption 100, minimum reorder period 10. Then the answer here is 3100 units. Danger level. The danger level is the point at which the stock becomes very low and the business must take emergency action to avoid production stopping. This is calculated in danger level equals to average consumption into emergency supply time. Average consumption 125, emergency supply time 3. Then the answer here is 375 units.
Effective stock management is achieved through the strategic application of two key areas, which are valuation and control. We analyze the primary stock valuation methods FIFO, LIFO, and VAM, highlighting how each impacts the cost of goods sold and inventory value for financial and tax purposes. Simultaneously, we demonstrated the importance of stock level concepts in maintaining efficient operations. These tools prevent both costly stockouts and wasteful overstocking. By mastering the correct use of these valuation and control techniques, organizations can ensure optimal material flow, accurate reporting, and enhanced profitability.